Just doing an audio check. Okay, we're doing pretty good latency. All right, folks. Welcome back. It is Saturday, February 25th, 2023. So I've already done the check on the audio, so we should be fine. Take a look at this risk disclaimer. All right, so we're looking at the dollar index as our daily chart. And as you go through these charts when there's nothing on it, it's important for you to pause, even though we're doing live streaming, pause the video, pause the stream, and take a look at what you see in terms of what I teach in conceptual form, order blocks, fair value gaps, where liquidity would be. And your chart should already have it anyway, but it's just for the purposes of new students that come here and watch the stream later on. All right, and here is where we are in the grand scheme of things. So we've moved from the highs here in the fall, October time period of 2022, came all the way back down to the sell side here. We walked this market pretty much the entire time. I mentioned that we would likely get into this fair value gap in the form of a buy side imbalance, sell side inefficiency, and hit this order block if we went below this low, which is what we were targeting. We ended up going down to consequent encroachment, which is the midpoint of that gap, which is the difference between this candle's high, this candle's low. Market created a market shift, bullish here, rallied up, came back down, bullish breaker, which is what's being annotated here, consolidated, traded higher, order block, lowest body, that one here, extend that over it, hits it, rallies, volume imbalance, trades down into it, and worked its way higher. Now, right away, that sounds like a whole lot of talk about what's already happened, but we have been live, real time, minute by minute, reviews, talking about what's going to happen, and I've taken your attention to this area up here, and you can see we're pretty much marching right on up into it. So what's up here that's interesting to me? Well, inside this area here, and we're going to go in tighter with this yellow shaded area in a second, but before I do, let me make mention of where we are in terms of the range. From this high down to this low, here's equilibrium to that range, halfway. At that point and above to get to premium, we have this premium fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency, meaning that this one single candle here, this down candle, that is inefficiently delivered. So should the dollar mount a continuation beyond this area, we're just looking at the next near-term objective, the draw on liquidity, which even through all this period here, we were looking for higher prices, meaning lower prices for what? Index futures, lower prices for euro dollar, lower prices for cable, pound dollar, all foreign currencies lower, dollar higher, stocks lower, because this is, with dollar rallying, that's risk off. So risk off is dollar rallying higher, and risk off means all assets, whether it be foreign currency or index and stocks, they're going to be easier to capitalize on short positions. It's more likely for it to go lower and reprice lower. So they enter sell programs where the dollar stays in a buy program. If we get above here, and we'll have to see how we get there, and we could still fail. But I believe, and this is where I'm saying that I believe it's still going, but until we ultimately do decisively fail, and I'll let you know if I think we have, I'm committed to this, as I've been for weeks. We're looking for this level here to be drawn to. Why? Inside this area, let's zoom in. Here's that area right above these two highs, and this is my volume imbalance. And volume imbalance is wherever there is two candles separated by only the wicks, no bodies overlapping. So the body of this candle has no portion of that candle overlapping with the previous candle's body of any value, not even meeting it equal. So if there's ever that forming on the chart, even though there is a wick or tail below this one and a wick above this one here, just because they bridge the gap between the previous candle's body and the next candle's body formation, that in itself doesn't do enough. It's inefficient. So the bodies must overlap, even if it's one touch equally to the previous candle's body. That's efficient. It's inefficient if it's only the wicks passing through, because wicks are viewed by the algorithm as a gap. So it's going to do what? Reprice back to it. We've seen it here, and it left it, moving away from it there. Has there yet been a body overlap this separation yet? No, it's just the wicks, which is the reason why I said down here and all through here, take your attention here for dollar. It comes up many times as a question in my students, even folks that have been with me for a long time. Since I teach a lot with intraday charts, 1 minute, 5 minutes, very, very small time frames, unless you're equipped to work with very quick decision making, it can be a little challenging. It could be scary because it doesn't give you, a new student, time to see the candle, internalize what it might be, because it's already now done formed 3 or 4 candles and it's moved. So it doesn't give you that benefit of time like a daily chart or a 4-hour or 1-hour chart, where it takes a lot more time for the candles to complete and start a new one. But you're still looking at price. Price is still doing the same fluctuations on the 1 minute chart, or if I'm using a 5-second chart, price is still updating, marking to market. It means every little tick fluctuation, every new movement in price, it's doing the same thing whether you're looking at it on an hourly chart, a 4-hour chart, daily, weekly, it doesn't matter. But the frame of reference is important, so that way when you go forward as you're learning how to trade and find these setups, you don't get confused as what time frame you're trading in. You're going to know what setup you're working within relative to that specific time frame. So to make things easier and to cater to the students that are not really equipped to trade in these lower time frames, not because they're not smart enough, they just don't want to do it. They just don't have the aptitude to stay with a model that's very, very small time frame, and they want to use their skill set on a higher time frame because of their work, their personality. It's just, it doesn't fit them to be an intraday trader, so they would have to be a swing trader. And I cater to that and all other approaches to trading using my concepts. And or if someone just uses whatever they trade with, many times they'll come here and they'll get whatever I believe the bias is, where the direction is going to go. And then they'll use whatever they like to trade with that bias. Well, I use a daily chart predominantly as my higher time frame, where I'm looking for specific key levels where it should draw to. The weekly chart, which I have not included in this, but I use that as a means of determining where the range is. And I don't have it here because everything I'm going to say here is going to accomplish the method without needing to pull up the weekly chart. What I look at on the weekend, or if I have plans with my wife and family and they make my schedule for me on the weekend, if that is the case, I'll look at the markets on Friday. But if I have time to do things over the weekend and my family hasn't made plans for me, then I usually do it Saturday before they wake up. And I look at a weekly chart and I try to determine what that weekly candle is going to do, most likely in terms of distance, magnitude, how big of a move can we expect, and what to reach for on the weekly chart. So without needing to pull that up, I'm just referring you back to this is where I believe we are going. And you can see we've been doing a pretty handsome job of getting very close to it. And we're going to break down some more details in a few minutes. But this is where I believe the expansion should be delivered sometime this week. It doesn't mean it's going to open Sunday and be there at this level. It could gap up there. It could gap up there. Or we could have a very low change, in other words, a very small change between where we closed here on Friday and where we open. And that's fine. We can come back down in this candle a little bit. I don't want to see a lot, and I'll talk about where I think that is reasonable. But I still think this right up in here, because of this volume imbalance, there's no bodies between the candles. They're not ever touching this candle at all, anywhere since. And if you look at this high here, and this high here, those are relatively equal. So retail theory, traders that utilize that and support resistance, which I don't do, price goes up to this level here, moves lower, trades up higher again, falls short of this one, but drops precipitously away from it, leaving this area to traders and those that like to use support resistance ideas. They think that this is a ceiling in price action or a resistance. And what would be resting above that? Buy stops. Two forms of buy stops. One, traders that see this as resistance and they want to buy a breakout. So they're watching this area here, because if it goes through it, they'll be long. I know it might not fit your appetite for types of entry and such, but there are many traders out there that trade just like that, and some of them make money. I don't personally subscribe to that view. The other form of buy stops that would be resting above here is large fund positions that are holding buy stops that would protect their short position. That's predominantly why it would likely go to this area here, because there's large orders resting, not just little minute volume that would come through retail traders. The people like you and I, we're not placing astronomical orders, the huge amounts of volume coming in based on our trades. And collectively, we still aren't a significant factor, but large funds are. So the algorithm that I said, I'm trying not to talk like this because it sounds too dogmatic and it offends a lot of people. So I'll keep the dogmatic perspective on Twitter. But here, price will generally gravitate towards areas where large fund liquidity would be. And the wonderful thing is the retail books are pretty much in line with where the large funds are going to put their stop. It's real easy above old highs and below old lows. And wherever there would be a clean level would be something like this, where the highs are relatively the same. So when I first started, I saw things like this and said, wow, that's resistance. I trust it. Let's go short. And if it went back up here like it's doing here, I would think, okay, well, this is probably going to be one of those triple tops, because that's what a book would show. And I don't view that at all like that anymore. I look at these levels as a means for targeting it. And if I can frame a trade that dries up into these levels, that's what I want. But because I do not trade dollar index, write that down in your journal. A lot of people say, are you long dollar? Did you short the dollar? I don't trade the dollar. I use the dollar as a barometer. I use it as a way of determining, should I be a buyer or seller of S&P? Should I be a buyer or seller of currencies? That any currency other than the dollar, if dollar's rallying, it's going to drop. That's the relationship with the currency market. So if I start most of my analysis on this instrument right here, dollar, it gives me a macro perspective in terms of risk on, risk off. So it alleviates a lot of the uncertainty that many of you as new traders or struggling break even or just frankly unprofitable traders, you're not incorporating this in your analysis, which is why you're getting very small movements in price, trading on these very small time frames, getting a little bit of movement and maybe over leveraging, because you don't understand where the market's likely to go. And if you want to trade with a longer term perspective in mind, it'll also aid, and as I'll talk about when you get into lower time frames, the ability to hold on to the trades longer. And while I'm teaching everyone this year to be actively pursuing 5 handles, that means 5 points, which is 20 ticks in the S&P. I lost my train of thought there because I want to make sure I'm referring to futures, and I'm so used to talking Forex. I thought I said pips. But in terms of trading this year and your learning, the things I'm teaching you with the S&P in price action, they work in Forex too. So if you're a long-term student with me, I know some of you are kicking and screaming, please talk more about Forex. I am talking about Forex. I'm literally talking about Forex. Every single time I'm talking about the currencies, and when I'm doing live streams, I'm bringing in the pound dollar, I'm bringing in the euro dollar, I'm talking about the dollar index. So it helps you keep your frame of reference where we are in the macro, which is the daily. The daily is going to tell you where we're likely to go, how we're going to get there. Is it going to be a big candle? Is it going to be a small candle? How do we know that? I'm going to touch on that today. But there's a great deal of advantage by using these daily levels and forming your bias on it. So in short, I look at a weekly chart before the week begins trading on Sunday, whether it be Friday or Saturday. Sunday, I try to do nothing. That's family day. I look at the weekly to try to determine where is the likelihood of that weekly candle to expand. Is it likely to expand higher, or is it likely to expand lower, based on whatever that weekly chart is showing me? In other words, if this was the weekly chart, and this is what I was seeing on a weekly chart, I would say, okay, I think the next weekly candle is going to open up and try to gravitate to this area right here, which is essentially what I'm saying here. But I don't need to show the weekly candlestick to do that because it's being illustrated here perfectly with the daily chart. So the benefit of having this perspective on price action, you're not getting confused and losing your bearings where you are in price on these lower time frame charts. Because if you are day trading and scalping intraday, it would probably be a safe bet for me to say your chart is so zoomed in, you only have probably 15 to 20 candles at most on your screen. You're watching every little tiny fluctuation over a very small sample size of intraday candles. And unless you have these things on your charts, it's gonna surprise you. You'll hear things come out of your mouth like, whoa, or wow, where'd that come from? Or whoa, did you see that? You're never hearing me say that. You're never hearing, when I'm live streaming, you never hear any surprise. Because I know what I'm expecting to see in price. I'm expecting price to deliver exactly how I'm expecting price to go where I think my long-term analysis leads me to believe it will go, which is what I'm showing you here. Okay. So we submit ourselves to an idea that higher time frame charts like weekly and daily are going to tell us where the biggest odds are for price getting to a specific level, which is the number one goal in your analysis. It's not how much can you afford on your next trade, or how much money I have to make to pass my funded account challenge. How many trades can I do it in 2 days and get my funded account passed? That's the wrong thing to be doing. That's the wrong thing to be doing. The only thing you're doing by doing that is ensuring you're going to fail at it. So the way you pass those challenges, the way you find consistency and finding setups that work in your favor is by following what these daily chart PD arrays are indicating. Where is the liquidity? Where are the inefficiencies? Is there any inefficiency from this high down in here that we would be concerned with where we close on Friday? Yes. This wick. We'll talk about that in a second. But prior to that, nothing, because we've already been pressing into it, which takes your attention to what? To an old high. So right away, before we got up to this level here, I had counseled you to look at 3 specific levels. One of them being this candle's high. I'm sorry, this candle's closing price. which is what I teach as my rejection block. Now, that doesn't mean, because the title says rejection block, if I'm bearish, which I'm not on this, am I? Have I mentioned any bearishness with the dollar index? Absolutely not. I've been bullish on dollar with the idea that we're going to go up into this area here. And I just told you in this recording as to why I believe it's going to go up there. The market needs to offer efficiency between this candle's closing price and this candle's opening price. So between these two candles, there's unfinished business. So the market will likely, it's not 100%, I do sometimes lose, but my faith in this is that we're going to go up there and lay down a candle that has the body crossing between the low of this shaded area and the high of that shaded area. It can be higher. It can go above it and come back down and just stop in the middle. That's laying a candle body in between these two price points. That's enough. That's all I would expect. Because we are not even in this area in price, and we're down here where we closed on Friday, that offers range of opportunity. So I have a range between roughly 105.26 to the top of that, which I just realized I'm using a PowerPoint. So you can get that range very quickly on your chart. But bottom line is we'll just eyeball it and say it's 105.90 something. We'll say 90. It may not be that, but whatever. 105.90. So we have essentially better than 50 points for what? Dollar. That translates to more in going short on pound dollar. It's larger in terms of pips for the euro dollar. So it offers downside range potential shorting those foreign currencies. And we are going to look at euro dollar in this presentation right after I get done with dollar. So right away, if you look at what I've already shown you here, I've given you a routine. I've talked about what it is you're focusing on. I've talked about why I believed that we're going up here in detail, even though you've known about it here, all through here, all the way up. And now we've already hit the first objective, which was that rejection block. If I was bearish, I would use that price to then look for a displacement lower. Now, please pay attention to what I'm saying, because I am not saying that I'm looking for dollar to go lower here. But because this is named a rejection block, I use that if I'm bearish, if the market goes up to an old swing high and it trades to and through, which is that closing price, if it does that and then shows displacement, what does that mean? A small short-term 1 minute or 5 minute candlestick swing low is pierced. It does not need to close below it. And if there's a fair value gap above that, I'll use the 2022 model essentially to get in and go short. That's how I would use the rejection block if I was bearish. But in this case, because I'm bullish on dollar and I'm believing it's going to go up here, the rejection block only acts as a target. It's an option for me to determine, okay, if dollar's reaching that level there, which is when I tweeted it, we've known this, we've been watching these price levels for weeks now. Once the dollar hits that, you're going to be looking at your euro dollar, you're going to be looking at your pound dollar, your foreign currency trade, or your S&P trade that's short, your NASDAQ trade that you're short, or your Dow trade that you're short, your DAX trade, whatever you want to name it, anything other than the dollar. If the dollar's reaching up and hits this area here, that's probably a good time to be doing what? Taking a partial profit, because it can go here and then consolidate. Oh, well, look what happened on Friday. All the market movement was pre-session. Then everybody got smacked around while dollar did what? Consolidated. We'll look at that in a couple minutes. But once we get through the rejection block, what's the next target? Well, we talked about the consequent encroachment, which is the midpoint of this candle's wick. This wick is a gap. So the market's likely to gravitate back to that midpoint of that wick, because if it's a gap, the inefficiency of a gap, the midpoint of that is consequent encroachment. That means it's consequential as it encroaches into the middle of it. Middle of what? The imbalance between the high and the low of the wick. So we were just an earshot right below that level, and we'll look at it more specifically when we get in lower time frames. And then that's our next objective. And I want to see it gap at it or just above it on Sunday. I want to see it gap above that and then just continuously press up. Or, if we gap above it, I want to see it come back down, retouch it, and then go higher. That's what I'd like to see on Sunday. So that way, now gun to my head, I'm not ambiguously saying things. I'm telling you exactly what I want to see. If it's not these things, then I'm doing nothing. I'm sitting with my hands in my pocket doing nothing. I'm not in a rush to make decisions. I'm not confused. I'm not lost in price action. I know exactly what I'm waiting for. I know exactly what I don't want to touch. If it's something that doesn't make sense to me based on my concepts, I'm not going to do anything. You're learning that this year. You're learning how to do that. And how you do that is what I'm showing you here. And it doesn't have the ability, or I don't have the ability, and the conceptual ideas cannot be communicated in a very short, condensed 5-minute training video. You can't take this stuff and compress it. You just can't. There's too much bandwidth there that needs to be used to cover everything. And if you want to learn how to do this the right way, you want to learn all the details, the subtle nuances, where you're going to fail. Because I've already taught you how to trade. I've already taught you how to look for setups. And there's still people complaining, I don't know how to do this, because they don't listen to these types of lectures. You have to know why you're doing it. And you have to understand why you shouldn't do other things. And by having that holistic approach to understanding price action, you'll have a complete tapestry of what makes the high probability setups and the low probability setups. So our next objective is that 105.341 level. And then beyond that, we have the wicks high here. So if it's going to go to this level here and go to this wick high, if it's going just to run above this old high and run above this old high here, doesn't it make sense for the candles to eventually gravitate into that shaded area, which is, again, that volume imbalance? Makes perfect sense, doesn't it? So by taking all those things together, adding them together, and understanding that there's been a lot of talks about WAR, okay, and conflict in other nations, and that type of thing causes concern. It causes the market to want to do what? Seek yield, but in a safe haven. So the way they inspire this is the market will start pricing higher on dollar because it's a flight to quality, a safe haven currency. So this is what's causing everyone to be even more nervous because they're seeing this go up. I got to make sure I'm trying to stay neutral in my delivery of this stuff, but it's very hard to. Because these relative equal highs are most likely holding a large liquidity pool of buy stops, anyone that would be long on dollar, it would be in their interest to see it go up here because they could offer their long position sold to the market to higher priced buy interest. So this buy side liquidity over here, that is where I think we're going, because there's a small little bit of a range between this candle's low and this candle's high. So it's not just this area here. There's several factors there. The fact that we have relative equal highs, there's no bodies in the volume imbalance, and we have a small little separation between this candle's low and this candle's high. So while I'm drawing your attention here, if at any time during this week we get into that shaded area, this shaded area has an additional area I'm watching, which is between this candle's high and this candle's low. So there's a small little gap there, okay? So that way you know. And what happens if it goes above that and it gets really animated? This wicks halfway point, which is consequent encouragement, okay? You also have the implied fair value gap, which I taught this week, or actually I introduced it rather. You have that occurring here. So you want to take the consequent encouragement of this wick and this wick, that range, project it out. If we go through that, man, we're really bullish on dollar. And that's probably a bad sign. That means a lot of things could go down hard. So I'm just tipping my hand to you, showing you what I'm thinking longer term out. But right now, I'm only watching these two levels and then the volume imbalance. My bias right now is bullish dollar. Everything else bends the knee and goes lower. That's what I'm holding fast to. That's what we've been following and watching the entirety of February. The entire month of February, we have been long dollar, short S&P, short NASDAQ, short Eurodollar, short pound dollar, short everything else, okay? So with that said, there's a long walk through it, I know, but it's how you learn it. Let's take a closer look into today. Here's the hourly chart here. So here's Friday's action. Unless you were already aware what we were looking for, which was that rejection block price down here, and then here is that consequent encouragement of that wick. And let me go back up one more time to make you aware of what I'm showing you. Not that. Look at that mug. You like that? So there's three levels there. The heavy dashed line is the rejection block. That's this candle's closing price. The dotted red line, that is the consequent encroachment of this wick. And then the heavy thick red line, that is the high of that candle's wick, okay? So that way you know where we're at when we drop down lower time frames. So now with that said, on Friday, it quickly ran right up to the rejection block, got real close to consequent encroachment of that wick. Remember that dotted red line, that's what that is. And then did what? Consolidated. Why did it consolidate? Inside this high, right here, the S&P reached an objective and the dollar failed to confirm that lower low in S&P. The dollar was not matching that. So that's a USDX or dollar SMT. I'll teach you more about it. You'll see examples of it in this lecture here. But it's also Friday. So it ran up all pre-market and then didn't do much at all. People that were trading were getting frustrated. I watched several live streamers visually and audibly share their frustrations with what the market was doing. And these are those instances where if you don't really know what you're doing, you can get angry, you can lose sight of what you're trying to do and lose lots of money trying to push an agenda, pushing something. And you want to be very careful doing that on a Friday, especially now with all of the things that are going on where, saber rattling is the thing right now. So anything can pop off. So it might run real close to those objectives, and it very well could have easily hit the consequent encroachment, which is that red line up here, that dotted one, the midpoint of that daily wick. The fact that it failed to confirm the higher high and lower low in dollar and S&P, and I'll show you what that looks like. Okay, I'm going to show you where it occurred, what it looks like, and all that business. Because it did that, and also tweeted it, I said, note the time, and the dollar index has not confirmed the lows with the S&P. It should have made a higher high in dollar, but it didn't do it. So because it didn't do that, that's reason and cause for caution. And also the time of day sets the stage for a lunch consolidation or reversal. And we'll talk about that in a second. But notice how this really nice sudden ramp up in price, this right here, that is very, very fun. That is a low resistance liquidity run versus something like this. It's going up, but it's met with what? High resistance. This is exactly what I'm teaching you this year to focus on. This is exactly what I teach and taught my private memberships. Okay, when they paid me to join and they were learning from me, I was teaching them both high resistance and low resistance, but with the benefit of knowing what a high resistance is and when not to trade in it, when will they form, and then where do the low resistance liquidity runs, where do they exist, where they develop in price action. That's what you're learning this year. Isn't it beneficial, at least visually seeing this? What type of trade would you rather be in? If you were trying to be long, if this was any other market, not the dollar, would you rather be buying in something like this where you're seeing a lot of this back and forth, buying and going all the way back and forth, and coming back, probably stopping you out, scaring you, think you got to get out of it? Or buying in this area and then rallying all the way up, and it's just a straight shot run, beautiful, just no looking back. It just keeps on driving where you want it to go. That's the type of move every trader wants. This is the stuff that books don't teach you, and that's why I'm teaching you over the course of the entirety of this year, because I want you to see lots of examples. You're going to see me talk about how the market is difficult right now. I have no problem or no shame saying it's difficult. There's times when the market is difficult, meaning it's difficult getting to where I wanted to see it go. I can go in there and scalp it just as well. Once you know how to do what I'm teaching this year, you can trade in difficult markets. I prove it. I'm on Twitter sharing it. I'm Twitter calling lives. Everybody's taking my tweets and dropping the links on their chart. You can see I'm calling every minute candle. Every turning point, where it's going, it's there. You can't deny that. You'll be able to do that at the end of the year. You'll have that skill set to do it this year, because you will know these movements here are coming. And you'll avoid doing these types of days here where it's just a lot of chop. You'll forecast when it's going to be choppy. When everyone else on social media is chomping at the bit to get out there and push the button, try to make money, get back some losses, you'll be sitting on the sidelines just cool, calm, collected, not worrying about it. And that's exactly what you learn by listening to lectures like this. You want to have very low emotions in trading. You don't want to be hopped up on goofballs worrying about where you're going to get your next adrenaline rush. And that's unfortunately what drives a lot of these traders today. They want to get in here because of the excitement. And I want to make money. I don't know why you're here, but these markets, to me, they're vehicles to make money. And if you can't find that as the root cause of why you're doing it, you're probably doing this for all the wrong reasons. So let's go into the 15-minute time frame. So here on the 15-minute time frame, we can see we have a buy side imbalance, sell side inefficiency, which is shaded here in that little blue box. Okay, and it's this candle's high and this candle's low. Incidentally, if you go down into a lower time frame 1 minute chart, there's actually a very smaller fair value gap that it's been working inside of all through here. And I'll leave that for your homework, but that also is where we've dropped back down into. Just fell short of reaching that 105.341 level, which is, again, consequent encroachment of that daily wick, the midpoint of the wick. All of this consolidation in here is what drove traders nuts. This level here is based on this high and that low. If we're bullish, this is where you can pause the video and do this on your own. Not yet, but let me tell you what you're going to do first. You're going to take your fib and lay it on this low to this high. And you're going to look for a standard deviation that gets to this level here, which is consequent encroachment, just below it or just above it. And if you do that, you end up with this. Fibonacci low to high, negative 1.5 standard deviation right there. Draw that out in time. There you go. So when I tweeted to you, when the when the dollar was failing to confirm the low that was formed in S&P once the S&P hit its objective for real, this area here qualified that this was going to most likely be an intraday high, meaning that we're going to do what? Consolidate or retrace back down into this wick. It could have easily went down into this here if it was dropping more during the lunch hour into the PM session on Friday. Why I was expecting that and why I felt confident by tweeting to you and prompting you, saying, look at the time. And we were getting ready to go into the lunch hours on Friday, New York lunch hours. And it's more likely for the market to enter a consolidation or retrace against the stops. But we're so close to running to those higher time frame objectives. What's it more likely to do? Retrace? Why would it need to retrace to go to that level? As it started marking time here, that is less likely. It just means it's going to do what? Consolidate into the close and hold everybody here. And that's what it did. And it retraced on all the other assets: Euro, Pound, S&P, NASDAQ, Dow. So we have precision here, but this is also an experience thing. You have to know, when's it really likely to continue? and it's Friday. We've already moved up a whole lot before the 9:30 opening right in here. Right in here. All this movement took place prior to that. So you're going to miss moves sometimes if you're only going to be trading at 9:30. You're going to miss moves if you're not trading around 8:30. You're going to miss moves if you're not trading overnight in London session, which is down here. I didn't catch this move. I was sleeping. You're going to have to accept the fact that you can't be in every move, and you have to be content with the analysis was on point. No problem. You're going to miss moves, folks, okay? It's just the way it is, just like you're going to lose on some trades and lose money. It's part of the business. It's how it works. Nobody can be in every swing. Nobody. So let's continue on this carnival-like atmosphere. So we have the euro dollar, our daily chart here. Now start moving along a little bit more quickly because I don't want this video to be too long. But right away, you want to pause the video and look at the levels that are important to you. And I know the majority of you aren't interested in doing that, but for the folks that are watching this video much later on, you can do that on your own. And I mentioned how when we were bullish on euro and bearish on dollar, I mentioned that this was too clean, too smooth, and we would likely trade up into this little area here and then ultimately get up into this area right there. And as luck would have it, the market trades up into that level. Beautiful delivery right there. And I know some of you are like, oh, this is cherry picked. Go back and watch on this YouTube channel. You'll see me do analysis before the fact. And I mentioned all this business over here. As dollar went down to our objective, dollar reversed, which would see what? Euro reversing. It trades lower. This high, low, higher high to a level we were aiming for. Once it breaks below that low right here, that low is broken there. If it would have did this and came off that's still a shift in market structure that's bearish. But because it closed below, now here's where you take notes, folks, okay? If you're just binge watching and Netflix and chill type attitude with ICT, you're not learning. You're wasting your time. If we close below the swing like that, you're going to treat that as a breaker. You won't need to think about coming back up into here in this imbalance. Oh my goodness, did you just hear what he just said? He just dropped a diamond. Yes, I did. Yes, I did. I'm going to be doing it all year long. That breaker gets touched right here. Does it respect it? Yes, it does. And we're what? Bullish on dollar. And it's trading to a bearish breaker. So this candle, when it hits it, is going to act as your resistance idea, that support resistance theory. You can't just look at every swing high and swing low and draw a line on it and think it's going to act as support or resistance, folks. I mean, I'm sorry, but that's not how it works. You have to have a narrative around why that specific high or low should act as resistance. And if you look at every instance where a pool of liquidity was rated and then rejected, in this case, the low before that high was formed, that's a bearish breaker. That's logic. That's real logic. That is not, well, every single swing high and low, let's put a line on it. You're going to be frustrated, just like I was, which is the reason why everybody that uses that garbage loses money and they fail. If you believe the statistics, and I think they're accurate, most new traders in the first 90 days lose their account. But what's on the other side of those losing trades? Someone winning. And they're doing what? The opposite of whatever they were doing. So you just can't simply look at every single high and low, draw lines on it, and think it's going to bring you to riches. It doesn't work that way. You have to have a reason why a level should act as resistance. Why should it behave for support? And it's on the basis of liquidity. Has it done damage to traders that would have existing orders above highs or below old lows? Then, once that occurs, that's why I call it a breaker. I named it a breaker because it broke the backs of everyone that would have already probably tried to sell short here. It started to drop, and then he ram it right through them, breaking their what? Future profitable short. That's why I named it the breaker. It's breaking them. And it also does it breaks their will. It breaks their courage. They are not going to go back in it. When it goes down here, they're gonna be like a deer in headlights. They're not gonna trust anything because now they have been what? Demoralized. And they lost money. And retail traders freeze when they lose money. Which is, again, it breaks their spirit. It breaks their winning position that would have been, if they wouldn't have had to stop right there, they'd be profitable right now. And I'm sure there's a lot of traders that were trying to do that in here because what? They looked at these highs over here, had a line drawn on it like I'm having here, but mine was that I identified the buy side. There's orders above that. I want to see it go above those. I don't want to see it go there and act as resistance, go down. There's a lot of traders that went in there, and as it hit that, let's go short, put their stop loss somewhere up here. And randomly, the market goes right to a level that I gave you and the reason why it should go there. And then it does the dirty work of going lower. So for smart money traders that were not able to get short up here, they get another opportunity. They find another bust stop. Here it is, the breaker. It comes right back up, hits it. Sell short. Now we're moving lower. So now I have this level here. Resting below that would be sell stops or sell side liquidity. From this high to this low, the midpoint is equilibrium right here. So at that level and above, we are in a premium. Next draw on liquidity is this low. Real orders are resting below that low. What kind of orders? Sell stops. Why would that be beneficial for the market to trade to that level there? Because they've already taken buy stops here and over here. And we moved sharply lower. So we have to assume, internal dialogue is this. We assume that someone with deep pockets, lots of money and big short positions are holding to get to a level where there's a lot of willing sellers below market price. Now, I said that correctly. They want to see the market drop from this height here and go down below this low here. Why would they want that? Because once the orders that get tripped below this low, as soon as this candle drops down, or the next candle or sometime in the future, it may not be this week, I could be wrong, right? Below this low, once it trades below that, every sell stop at that price level becomes a market order to sell at the market. So it's tripping in a rush of liquidity in the form of a great deal of sellers at low prices. So what do you do when you go out to the store and you see something on sale and you got the money for it? You buy it, right? Well, to get out of the short position, smart money is holding from up here. They're going to want to buy it back. They're just going to buy it back because it's made 20 ticks. Are they going to buy it because they made, 500 points, ticks, pips, whatever? No. They're looking for a logic behind where the market's going to go and where does it reside, where it has a large degree of contrarian opinion. Sell stops protecting long positions is what's going to be targeted here. That's what's in sight right now. It's advantageous for us as speculators to believe and trust that it's going to go below that low because there's somebody making money right now. And we don't know who they are. We don't care to know. We don't need to know how much they're making. But they're making money. And this type of move is meaningful because it's dropped a lot. So where's it going? Some random level? No. Where there's an obvious level for sell stops resting below this low here. So they sold short to buy stops. So they sold at high prices. And they're going to buy back at low prices where existing or engineered liquidity will be resting. This here, where it runs up, drops down, that's engineering liquidity. When does engineered liquidity form? Oh, here's another time for your journal. Between here and all the way back here, that's a lot of time. That's a lot of time. So what happens is it takes up to that level, falls short of it, drops down, and traders do what? They go short, which inspires them to do what? Place buy stops resting above here. So when the price gets delivered up there, that series of orders that would be resting above these highs here, plus large fund orders up here, because they're going to trade longer term, and the inefficiency of this area here that's shaded, that's a fair value gap. All of those boxes get checked. So when that happens, smart money, the way I'm teaching you how to decipher price, to engage price, to see the real market, not patterns, not retail stuff, you're looking at it with a market efficiency paradigm. That perspective is you're looking for the fluctuations and delivery of price to do exactly how I'm teaching you it does. It's not trading because there's patterns, whether they're classic patterns or new wave harmonic animal patterns, which absolutely is ridiculous. The market only operates on time and price, and it's going for where the orders are resting, which is above old highs or below old lows, or it's rebalancing areas of inefficiency and price, which is what I'm shading you in this little box right here. Okay, so our thought process is going forward, we're still holding with higher dollar and lower euro, and we're going to be monitoring how we trade at this low here. So as long as we remain below this breaker, we're bearish. I'm bearish on euro, expecting that low to be taken out. Very simple, isn't it? What's your bias going forward for the week? Looking for lower prices on euro dollar, looking for higher prices on dollar. Simple. If we get animated, right? Remember I was mentioning earlier with dollar. If dollar gets really explosive on the upside, say something happens, on the other side of the world, and you know what I'm talking about. That could cause the markets to do a whole lot of things. And one would be the dollar going up a lot. If that happens, that discount fair value gap in the form of buy side imbalance, sell side inefficiency, which is BISI. That's one candle moving up with the previous candle's high being lower than it, and the next candle's low being higher than the previous candle's high. So that separation between those two candles with this one candle, that is a fair value gap. What specific style of fair value gap? BISI, buy side imbalance, sell side inefficiency. Equilibrium's here. So if it wants to go to a discount, that's where my eye is right here. Okay, so I'm giving you my longer term viewpoint out in time, but right now all I'm focusing on is here and how we trade to it. Do we just shallowly go below it and retrace back up into the range, or do we smash through it and just really accelerate? That's what I'm waiting to see. But my 100% focus is we're going here as my bias, and below it, that's what I'm thinking, with higher dollar. That's not ambiguous. Here's the hourly chart on euro, and you can see that we've been moving lower. I'm not going to give you the lower low, lower high crap, because that's not market structure. That's just a trend. So, but what we do is we like to look back in all of the delivery of price. Right in here, I have no annotations on these charts because I'm counseling you to do it on yours. But right in here, you have a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. This candle's high right here. If you draw a line out, this is institutional order flow entry drill. Institutional order flow entry drill is where the market just trades just a little bit inside the fair value gap and then drops. That's what that is. It's not a full closure of the gap. It just goes in a little bit and then go. That's why when you see me pyramiding and when I'm doing my trade executions, every single time I do a entry into the fair value gap, I'm always trying to pyramid right there. Because every time I try to fancy dance and try to get the midpoint, consequent encroachment, I rarely ever get it. So that may be where I believe that the ideal entry should be for me, but I don't care about the couple ticks that I might be losing in terms of profit or saving in a stop loss. That's not going to make or break the idea for a trade for me. So as it enters the fair value gap, institutional order flow entry drill, that is usually abbreviated by IOFED in my chart. All that means is you're entering just the smallest little bit inside of a fair value gap, and you're entering based on that within a narrative or directional bias, with the belief that even if it does close in the fair value gap entirely, it doesn't make a difference. It won't hurt me. I'm not going to take the full position there. I'm going to enter a partial of something like a pyramid. So if I'm going to enter it as a full 100%, this is the first time I'm getting in a trade because maybe it's already been moved for a while. I'm not afraid of looking at that and getting short. where some of you might think, oh, we're down here near support. Look, we're down here by support. It's probably going to go up now because, that's probably what's likely to happen when they have no idea, because of what I've explained here on the higher time frame. They're lost. They're the ones that are lost. They're trying to go long in euro. They're trying to find longs in this market when your focus should be filtering out longs, only focusing on shorts. And every time the market rallies, your thought process should be, this is a suspect rally. Why is it going up? Here's the two reasons, and the only two reasons it is going up. You ready? Do you have your pen in your hand? Put the potato chips down. The only reason why the market's going to rally and the market's bearish, right? You're expecting prices to go lower. Every single time that the market rallies, it's going up to tag short-term highs for buy stops, or it's returning to reprice to an inefficiency. What? This high here ran above this high. This high here ran above this high. See that small little separation in here? Very small. It overshoots it in here. That's fine. Breaks lower. What's this rally doing? Inefficiency right here. And what's this wick? Split that wick in half. Boom. That's inefficiency. Wicks are gaps. Anytime you're bearish, folks, listen, okay? Listen. You have complicated this stuff, and you all have heard people say, I complicate it. I've turned this into a science. All you have to do is know the language. Simple processes and rules. If we are bearish based on what we think the move's going to be on the weekly chart, is it going to be expanding higher or expanding lower for an objective that can be seen on the weekly chart? That's the beginning of building a bias for the week, not daily, for the week. So that means we're looking for only buys if we think the weekly chart is going to print a candle that's expanding higher. Right away, you don't care about going short. You don't care who's on social media making money, showing things. You don't care. No one's going to influence you. You're following your methodology. You're not going to know when you're going to know when you're wrong, and you're not going to be confused about when you're wrong. It just didn't pan out. You did something wrong. Keep going. Keep moving forward. Whereas if you try to chase everybody else's opinion, and when you're wrong and they're wrong, it's frustrating because you don't know how you can prevent that from happening again. Whereas if you have a model, you know if it fails, okay, no problem. My money management took care of me. I can still trade the next trade when it forms. And I'm not afraid to take it because these things work more times than they fail. Then you go to your daily chart and you look at, okay, I'm looking for the next areas of interest, these key levels, which is what I shared on the charts thus far. Where's the market gravitating towards? Where's it moving towards? That's what you're focusing on. So by having that, you're giving yourself an advantage of following along with a higher time bias and not being scared or second guessing yourself or going against that. So inefficiency, it trades to a here, drops. Small little rally. What's it rallying up into? Inefficiency to drop. What's it rallying up in here? Inefficiency to do what? Drop. Inefficiency here. What's it doing after it rallies? It goes right up into small little inefficiency. And this one here, what does it do? Drop. See these highs here? Too clean. Rallies to do what? Take the liquidity there. Then what? Drop. When you're in a sell program, that means you're bearish. You're expecting prices to deliver lower. It's only going to rally to do one of two things. Go into inefficiencies, which is fair value gaps above price, or run out a short-term high. That's it, folks. That's all these things do. Whatever. The algorithm is doing just that. Okay? It's coded to just do that. It's not looking for animal patterns. It's not looking for supply and demand zones. It's literally doing what I just said. All the time, every single day, every single week, every month, every year. It's going to do it all the time. It's never going to stop doing that. It's all it ever does. That's it. Once it does that, it will continuously reprice to what? There's a level down here. What's this level? That's that low. We're expecting it to reprice to that down there. Here's the Eurodollar 15-minute chart zoomed in. And usually when you guys are watching other people talk about their analysis and such, and you may be doing this in your charts too, if I show you this chart like this, And if you're a new trader, you're looking at this as, oh, this is going to be support. I would be buying that. I would not be buying that. So when you're doing your analysis, you need to dress your charts correctly. You need to have your levels in your chart. So that way you're not looking at a chart with the skewed perspective that, oh, this looks like it's too low now. Now when I show the chart like this, you can see where I'm showing a daily sell side liquidity pool. The movement below that low is what we're expecting on the daily chart. But if you don't have that on your chart while you're watching price, you are completely clueless as to what it's gravitating towards. And you're going to be influenced by every small little fluctuation in price. So you have to dress your charts properly. Have your higher time frame key levels on your chart as it's reaching for it. You cannot be effectively trading if you're using these ultra small time frames, 5 minutes, 4 minutes, 3 minutes, 2 minutes, 1, and you're zoomed in and you only have a handful of candlesticks. You know, you can't do it efficiently like that. And you're going to get overly emotional when you need not to. You got to have the right things in your chart, folks. All right, S&P. I'm going to get through this a little bit quicker now because I just realized on this, I did not bring my cable, and I don't want to stop talking to go get it. That would be rude because we're doing it live. So here we are. We're in S&P daily chart, and you want to pause the video, make a note of anything that you observe, and then unpause the video when you're done. But for those in this attendance that are impatient, here's what we're focusing on. Here's our key levels. It's my key levels now, but we're going to zoom in on that little shaded area. But before we do, just be mindful that I took your attention up to these relative equal highs earlier in February. We were going to trade to that. We did. I said we were in this range. It needs to leave the range. Once it leaves the range, we'll be more confident about where it's going to go. Why did I know we're going to be in consolidation? Because we had 2 volume imbalances here, and we had already taken the buy side here. And we had to submit to what? The expectation of higher dollar, which does what? Offers the likelihood for this to go lower. Zoomed in, here's those key levels in here, and you can go through on your chart and figure out what these are on your own specific time frame. You're welcome to take these as your journal notes as a new student, but it's important that you do this in your own charts. The consequent encroachment of this wick here, that's what the 40.23.5 level is. The mean threshold of the bearish right here, this candle, actually I have that noted wrong. That's saying negative OB. That should be a bullish order block, but now because we're below it, it would be viewed as a bearish order block, so don't be confused by that, okay? Yeah, you just learned something there, didn't you? What did you just say? Just rewind it, it's there. And then you have the old low, and then the consequent encroachment of this midpoint of this gap here, okay? And we're going to break this down and teach you something really cool. Zoomed in, we have this small little gap down here. Prior to Friday's trading, this was unfilled, or it was left open. And on Friday, we delivered it right to it. Mean threshold, consequent encroachment of the wick here, trades up into it there, and then delivers down to that level. That is very, very precise. Everything in here we'll come back to, but I'm going to take your attention to something very specific with that gap right there. Focus on that fair value gap. Do you see anything that stands out? Anything that's important? Pause the video, think about it. I'm about to start. Here is your fair value gap. This is what you're used to seeing. This is how I teach it to you, okay? Algorithms, high-frequency trading algorithms, will take that inefficiency there and bust it up into quadrants, okay? And I'm going to show you how I was able to talk about Thursday's trading when the GDP number came out and how I knew where it was going to go and all that business. I was looking at this gap here, and this is the anatomy of the fair value gap. That entire range, you put it in quarters. So there's a quadrant from the highest to here, midpoint, lower third, low. Those levels, if we take those levels and add them to the hourly chart, watching the live stream on Thursday morning when you heard me talking about with my son, the low here, the fair value gap here was at the low end of what? The high, upper quarter, midpoint, lower quarter, low of that daily fair value gap. Look where that fair value gap 60-minute resides? Right at that lower quadrant. I only want to see it trade up into that. I don't want to see it go above the halfway point, because if it does, that means it's probably not as bearish as I want it to be. So the best short positions are going to occur at the midpoint of that gap on the daily chart, which is that dashed line, and the low. So it goes up to the upper quadrant, and it's the 60-minute fair value gap. High frequency trading algorithms are going to trade that right there. And market drops lower. This idea, you're going to couple that with what I've been teaching about how when prices don't reach to a specific level and fail, it indicates exceedingly bearish or exceedingly bullish. And I'll teach more about that this week. I'm also going to teach you more about new week opening gaps in a very specific lesson in entirety by itself. It's nothing else but just that. Okay, so that'll be on Wednesday. And on the 15-minute time frame, you can see it here. So it runs up, hits that lower quadrant level of that fair value gap on the daily chart, and the premium 60-minute fair value gap, which doesn't look like a fair value gap now when we look at it on the 15. It's important to move from the top down, higher time frame, lower time frame. More specifically, here is that higher high that's formed in between these two time periods, these vertical lines. Look at that. The S&P made higher highs there into the area I was drawing your attention to, and it's the lower quadrant on that daily fair value gap. And at the same time, the dollar index was unwilling to do what? Make a lower low. See that? So that's SMT. USDX dollar index. SMT. It should have made a lower low there. It didn't. So when it does these things, that is what? That's flashing like the beacon saying, okay, smart money's going to go short here. And what's it going to aim for? Sell side. Why? Because it took the buy stops above here. So if they're going to buy, if they're going to sell short to the buy stops here, what are they going to look for to get out? Sell stops. They're residing right below there. Where's the market go? Right there. And then what does it do? Right back up to the fair value gap on the daily chart. Bounces there, hits it here, new week opening gap. Go and look at Twitter. You got to watch Twitter. Goes into new week opening gap, and then does what? Oh, I can't do that. I thought it was live, didn't I? It goes lower, obviously. And zoomed in on a 5-minute chart. There's the details again. Beautiful higher high into a level I was calling. And there's the SMT divergence telling you it's going to drop. Back to our chart here with all the details. Okay, so we're going to use these levels here now when we drop in. Hourly chart here with all the pertinence. Old low, consequent correction of the wick, order block, mean threshold, and we break down through it, and there's that hourly gap. And here is that 4023.5 level, and this is where people get lost in the videos. That's why you have to watch and write down with notes. The consequent correction of the daily chart wick. That's what this is here. And the market goes back up to it here, and then prices down to that old order block and low on the daily chart, which is 3948.75. So just a beautiful delivery of price action this week. Zoomed in here on the hourly chart, you can see how we just went up in the fair value gap. You know now what that was also here, the daily fair value gap lower quadrant. And then once it hit it, repriced lower, right back to the 4023.5 level, which is a wick consequent encroachment. Consolidation looks like a bullfight to retail traders, and then just rolls on down to a level that completes the sell program for near term on a Friday. And then with that divergence down here, which we'll go into, the market trades up higher here also in that fair value gap, higher into this high here. But look what's occurring here in the NASDAQ. NASDAQ was doing what? At the time, NASDAQ was giving you the S&P divergence. It did not make a higher high when Dow did, when the S&P went into our objective. That is smart money going short. And the market does, in fact, reprice lower. No indicators, folks. This is just the actual price of Dow and NASDAQ. And in the afternoon, when I was prompting everyone on Twitter that there was a divergence of the dollar and the S&P when it made its lower low, you can also see that being confirmed in the averages. So when we filled that gap on the daily chart here, you can see we made the lower low in S&P. We did not make the lower low in Dow, while we made the lower low in NASDAQ. We are done for the daily range. It's going to reprice go where? Buy side liquidity. That's here. We ran above it here, retraced, fair value gap, rally again, consequent encroachment of the gap here. And notice it didn't just go up to this low here where what? Support broken turns resistance? No. It digs up to an algorithmic reference point, which is the consequent encroachment of this gap. And I promise you, you will learn much, much more as we go through this year. But unfortunately, that's going to be it for this one. And I will touch base with you on Monday, I'm pretty sure, Lord willing, through Twitter. Enjoy the rest of your weekend. Until next time, be safe.